The Federal Reserve's decisions ripple across the global economy. Understanding its history, structure, and policy tools is crucial for every investor and citizen alike. Imagine a small committee of 12 people deciding the fate of trillions of dollars every day. Their choices influence interest rates, asset prices, and even your mortgage and paycheck. Welcome to our deep dive into the Federal Reserve, the world's most powerful central bank. Few institutions wield as much influence over global markets as the Federal Reserve. Its missteps contributed to the Great Depression of the 1930s, and its bold policies ignited a US stock market bull run that lasted over a decade. When oversight waned, it triggered financial tsunamis like the savings and loan crisis and the 2008 meltdown. Today, the Fed shapes everything from inflation to employment to currency strength. We'll explore how 12 people seated around a table can steer the US and global economy, then show you why tracking their every move is essential. In early America, suspicion of centralized power ran so deep that for over 125 years, out of the nation's first 250, there was no central bank. When the young republic needed funds for war, Congress chartered the first and second banks of the United States, temporary solutions that closed after 2 decades each. Meanwhile, private banks issued their own banknotes backed by gold, silver, or government bonds, a wild west of free market currency. But bank runs and the panic of 1907, when JP Morgan personally rallied capital to avert disaster, exposed the system's fragility. In response, Congress passed the Federal Reserve Act in 1913, birthing a hybrid institution designed to balance governmental authority with private bank interests. Unlike many central banks, the Fed isn't a single entity. It's the Federal Reserve System, a network of 12 regional reserve banks supervised by a board of governors in Washington, D.C. Each regional bank is technically owned by its member commercial banks, which hold non-tradable stock and elect local board members. Yet key policy decisions, setting interest rates and controlling money creation, are made by the Federal Open Market Committee, FOMC, a central body of 12 voting members. 7 governors appointed by the President and confirmed by the Senate for staggered 14-year terms. The chair serves 4 years. 5 Reserve Bank presidents rotating among the 12 districts, with New York's president permanently seated. This design weaves in checks and balances. Private banks fund and elect regional leaders, while government-appointed governors direct policy, yet cannot be easily removed, protecting Fed independence. The FOMC meets 8 times yearly, every 6 weeks, to debate monetary policy. Its statement and meeting minutes move markets instantly. Global investors watch for rate hike decisions or dovish signals. FOMC members are stereotyped as doves, favoring lower rates and more stimulus, or hawks, prioritizing inflation control. Knowing who leans which way, whether Yellen's dovish stance or Powell's more neutral approach, helps traders forecast rate moves. And when the delicate balance tilts, entire bond and equity markets can surge or sell off within minutes. Fed independence isn't accidental, it's vital for credibility. Even though governors are presidential appointees, removing one requires a 2/3 Congress vote. Remember 2018, when President Trump publicly criticized Fed Chair Powell for hiking rates. Powell remained unbowed, underscoring Fed freedom. This insulation encourages long-term thinking, maintaining stable prices and maximum employment, even if that means short-term political discomfort. Preserving trust in the dollar's integrity ultimately bolsters US influence abroad. In 1979, inflation soared above 10%. Enter Chairman Paul Volcker, whose uncompromising rate hikes pushed yields above 20%, crushed inflation and sparked a deep recession and political backlash, including death threats and pressure from President Carter. Yet Volcker held firm. By wresting inflation under control, he restored faith in the Fed and paved the way for 2 decades of economic expansion. His tenure cemented the Fed's reputation as an inflation-fighting guardian, at the cost of short-term pain but with lasting gains. The Fed's primary weapon is the federal funds rate, the overnight lending rate between banks. Tweaking it influences consumer loans, mortgages, and business credit. Yet in crises, rate cuts alone proved insufficient. In 2008, as rates plunged towards zero, markets froze. The Fed borrowed a page from Japan and launched quantitative easing, QE, buying trillions in long-term treasuries and mortgage bonds. By driving down long rates, QE fueled a stock market rally, revived confidence through a wealth effect, and helped curb unemployment. But it also created market dependency. The infamous taper tantrum of 2013 erupted when talk of reducing QE caused bond yields to spike and equities to tumble. Every policy has side effects. QE flooded capital into stocks and real estate, amplifying asset price bubbles. Low yields incentivized corporate buybacks over productive investment. As loans remained on banks' balance sheets, real economy lending lagged. And with repeated bailouts, Wall Street grew accustomed to a safety net, fueling risk-on behavior. Today's challenge for the Fed, balancing crisis intervention with the risk of perpetuating moral hazard. Stricter supervision and macroprudential tools are part of its evolving response. Why should you care? Because the Fed's decisions affect everything from mortgage rates to currency strength to stock returns. Platforms like Moomoo and TradingView now track Fed meeting calendars, dot plots, and economic indicators in real time. As we navigate high-interest environments, QE unwinds, and potential bank stress, staying ahead of Fed signals is non-negotiable for every serious trader and investor. Remember, don't fight the Fed. Odds are, whoever controls the money supply controls the markets. Thanks for watching. If this deep dive helped you, hit like and subscribe for more macro and market insights.